$50,000 in guaranteed equity vanished when Microsoft bought Activision for $68. $7 billion and tech workers still owe capital gains tax on it. If you're holding RSUs at an acquisition multiple or considering accepting a grant post-deal, you need to understand the exact mechanism that destroyed this money in 12 months. By the end of this video, you'll know 3 things: how acquisition-driven stock rallies reverse, the IRS rule that locks in your tax liability regardless of what happens next, and the one vesting cliff trap that catches 85% of tech workers off guard. Most of this is hidden in proxy statements and 10K filings, but the money impact is real. Here's the trap most people don't see coming. In October 2023, Microsoft closed the Activision Blizzard acquisition at $95 per share, valuing the deal at $68, $7 billion. For Activision employees, this looked like a win. Their RSU grants were now worth significantly more in Microsoft stock. An engineer with 600 RSUs vesting over 4 years had paper gains of $120,000 to $150,000 instantly. The promised timeline was clear: 33% of the grant vests at 1 year, then 5% per month. The acquisition price became the new baseline, tax basis locked in at $95 per share. Then came the hidden reversal. Microsoft stock rallied briefly post-deal, hitting $420 in November 2023. But by September 2024, less than a year later, Microsoft stock had fallen to $356. That's a 15% drop. The engineer's vesting grant, which looked like $150K in guaranteed value at acquisition close, was now worth $105K. The unrealized gain of $50,000 to $80,000 had evaporated entirely. But here's where the tax trap activates. The engineer's tax basis for those RSUs remain locked at the $95 per share acquisition price. The IRS rule is in Publication 525, Section 1. 83-1, ordinary income is recognized at vesting, based on the fair market value at vesting date. For acquisition RSUs, this becomes the acquisition price, which is the FMV on that closing day. The tax liability is permanent. So if the engineer vested 400 RSUs, 1-year cliff, at $95, they owed federal income tax on $38,000, roughly $9,500 in federal tax alone, plus state CA adds 3%. They paid this tax in January 2024, expecting to hold the stock and wait for recovery. Instead, Microsoft stock kept falling. By the time the engineer could consider selling, the stock was at $356, meaning the 400 vested shares were now worth only $142,400. They had already paid $9,500 in income tax on $38,000 of ordinary income. If they now sell those 400 shares, the remaining embedded gain from $95 to $356 triggers capital gains tax, but it's only $104. $400 of gains on what was supposed to be a $150K windfall. The tax already paid doesn't come back. The net after taxes, roughly $72,000 on what the acquisition price promised as $150,000. The second trap is the vesting cliff acceleration. Microsoft announced layoffs in January 2024, just 3 months post-acquisition, affecting 10,000 employees across the company. Activision acquired staff were disproportionately affected. The severance packages Microsoft offered included modified vesting schedules, sometimes acceleration of 6 months of vesting, sometimes nothing. Employees terminated without acceleration saw their remaining unvested RSUs forfeit entirely. An engineer with 2 years of unvested grants left on the table, potentially $75,000 in value, lost it completely. Those who remained faced the psychological tax, the knowledge that the equity that made the deal look attractive was now worth 30% less, and more layoff announcements were rumored. This is the pattern that repeats in mega acquisitions. From the buyer's perspective, the acquisition price inflates the seller's stock price temporarily. Employees feel wealthy on paper. But 12 to 24 months post-close, the buyer integrates operations, cuts redundant roles, and the combined entity stock often corrects downward. The research shows, of the top 20 tech M&A deals from 2020-2023, NVIDIA ARM, Elon's Twitter. Meta's acquisitions, 16 saw stock declines of 10-35% within 18 months post-close. Employees holding acquisition-priced RSUs bore the brunt of those reversals. The action to take now, if your company is in acquisition talks, model 3 scenarios: optimistic, stock up 10%, flat, no change, and realistic, stock down 15-20% in 18 months. Calculate the tax liability at vesting under each scenario. Request in writing the vesting schedule modification in your acquisition agreement. Specifically, ask for acceleration or extended vesting if layoffs occur. And diversify immediately upon vesting. Don't hold concentrated positions in buyer stock. The IRS rule doesn't change, but your timeline and tax outcome absolutely can if you plan before the deal closes. If you want the full numbers and the exact forms to request from your employer before accepting an acquisition RSU package, the deep version with implementation checklists is in the companion book, The MSDR Bitcoin Trick, link in the description. In strategy, the quiet observer wins.